can tie more of how they're feeling whenever stocks are going down. That's obviously going to affect sentiment, but also to tighten those conditions. But a big issue facing the Fed right now is obviously credibility. And last year, especially doing the whole transitory situation and being behind the curve on that, I think the biggest thing is they want to look like they are taking this very aggressively, taking it seriously, and are also trying to fight any sort of situation that the economy could get in if stagflation tends to unfortunately happen. So growth is coming down right now while inflation remains high. So they want to really squash those fears. And when I talk to investors and traders, they really feel that the more aggressive the Fed is, that actually is a good thing because that would prevent a stagflation type scenario happening.
So, Mike, I do feel like, though, the market has led the Fed really this whole time. So if stocks are able to, and I understand that we didn't really stage a strong turnaround, right? The S&P is down 0.3%. But if stocks can find their footing, does that make the Fed's job even harder?
Well, it does, and that's one of the reasons that Jay Powell was so direct last week. He wanted to let the markets know the Fed was not changing its views. It was planning on being as firm as possible going forward. I think you have a couple reasons why the markets had been trying to push the Fed around. One is that the old saying that Ronald Reagan had about trust but verify, they want to know that the Fed is actually going to follow through. So it may take some time for the markets to adjust if the Fed actually raises rates to the fact that they are actually raising rates. They heard what he said, but they want some proof. And there are actually some people saying that, well, he didn't rule out specifically lowering rates in 2023, so maybe we'll trade on that. It's also low volume right now with a lot of people who are at the beach waiting for Labor Day. And then, of course, we're waiting for that jobs report on Friday and the CPI report on the 13th, and that's really going to make a difference in what the markets think.
Yeah, it's hard to hear, isn't it, Alex? People on the beach waiting for Labor Day, and here in the UK, still coming back from their vacations, you know, extended weekend breaks after yesterday's bank holiday. Jess, I want to ask you about some of the implications of what we're hearing from the Fed, this honesty about what it means when we see stocks fall. We know what that does to financial conditions, and we know that the Fed wants to see those financial conditions a little bit tighter. Does that take us as far as to think, though, that there is the opposite of a Fed put? This idea used to go around the markets that the Fed would, you know, have the stock markets back if it fell too much. But now we don't take it so far as to argue the reverse of that, do we?
Right, and especially because the whole argument about whether or not we would potentially see a Fed pivot. In prior cases when we've seen V-bottom since the housing crisis, this isn't that type of situation. This is definitely a longer-term type environment. And Bespoke Investment Group actually had a note recently that pointed out how many times we saw 5% rallies or more during the dot-com bubble or during the housing crisis. And both times were about a dozen times. So investors don't really expect to see markets just continue to go up and up and up. They expect it to see this type of choppiness that we have been seeing. And we are in a midterm election year, which causes a lot of weakness seasonality. We're about to go into September, which is historically the weakest month of the year for the stock market. So there's a lot of hurdles the market's coming up against. But looking back toward yesterday, there was some resiliency from where the market actually closed compared to where pre-market action was happening. So that's really important, especially looking at where the S&P 500 is trading, staying above that 50-day moving average, especially as long as the S&P 500 is below that 200-day moving average, it's still going to be really volatile in the fall.
So I just want to wrap in some headlines that we're getting. This is from the Ministry of National Defense for Taiwan, talking about the Taiwan military is firing shots to fend off civilian drones. They detect civilian drones near offshore islands. And I'm just looking at the S&P down by 0.6%. And I guess what I'm trying to understand is just how the conviction in any kind of move that we have seen to the upside. It's my way of also asking about positioning. Like, are the shorts already in the market? Doesn't take a lot then to see short covering, or is there a lot more room to put on some puts for the S&P, for example?
Right, so Bank of America actually released their client flows data today, and it really looks back towards what was happening yesterday. And so last week, clients sold equities for the second consecutive week, and the outflows were actually led by hedge funds. And hedge funds, looking at some separate data from Goldman Sachs Industry, it was more looking at how hedge funds had been ramping up their bets last quarter to the highest since the start of the pandemic. And that's really due to they were expecting that if there's weaker growth, maybe potentially that could spur this trade of kind of safety trade when you're looking at mega cap technology stocks. So they were betting on that happening. So now you're trying to see that maybe there's some signs of that unwinding again. So that's a key area, especially when you're looking at how hedge funds are potentially shorting these, and especially because a lot of the rally that we've seen since the June lows have actually been spurred by a lot of how those positions had been placed. So that's going to be a really key focus in the coming weeks, and to still eye exactly what that data looks like.
like.
Yeah, especially, as I say, end of August, light volume, etc. All right, guys, thanks a lot. Really appreciate it. I just mentioned from Bloomberg and Michael McKee. Thank you both very much. All right, coming up, it's more of our question of the day. Why is the Fed fighting the tape? We're going to put that question to Catherine Avery of Catherine Avery Investment next. And as we head to break, more Fed speakers coming out reaffirming a central bank's commitment to fighting inflation at any cost.
You've likely seen that over the last 4 meetings, we've raised rates 225 basis points. We've started shrinking our balance sheet, and we've signaled there are more rate increases to come. We're committed to returning inflation to our 2% target, and we'll do what it takes to get there.
The Fed gathers at Jackson Hole.
This is not a normal Jackson Hole.
Our expert team is there.
Michael McKee, Jackson Hole, Wyoming.
What is your baseline?
First with news.
We will keep at it until we're confident the job is done.
First with names.
Inflation is too high, and we're going to do what we need to do.
Sooner is better as far as I'm concerned.
First with analysis.
The Fed has to be harsher than expected.
Central bank mea culpa.
You may well see more unemployment.
I don't think this is a time to declare victory over inflation.
When it comes to the Fed, Bloomberg has you covered first.
I certainly was not excited to see the stock market rallying after our last Federal Open Market Committee meeting, because I know how committed we all are to getting inflation down, and I somehow think the markets were misunderstanding that, and I was actually happy to see how Chair Powell's Jackson Hole speech was received. You know, people now understand the seriousness of our commitment to getting inflation back down to 2%.
That was Minneapolis Fed President Neel Kashkari weighing in on the market action, which takes us back to the question of the day. Why is the Fed fighting the tape? Are they fighting the tape? Joining us to discuss, Catherine Avery, the CEO of Catherine Avery Investment Management, a 100% female-owned firm with $107 million in assets under management. Catherine, I love the Kashkari conversation because he basically said what we all think and know anyways, that the Fed does watch the equity market to some extent when it comes to policy. Is the Fed ignoring the markets, or is the markets ignoring the Fed?
I think the Fed's ignoring the markets. They were pretty crystal clear on Friday saying that they are going to raise the rates and their mission is to tame inflation. They were already so far behind the curve that they will lose a lot of credibility if they don't go ahead and move forward and raise the rates. The one thing that we have to worry about is that a lot of the inflation that we're seeing, the inflation in the energy prices, inflation in food, inflation in rents, it's pretty sticky, and we're not going to see immediate gratification of a drawdown in those pricings just because the Fed's raising rates. So this inflation is going to be sticking around for a lot longer than we had originally thought. And the big question moving forward is, how do investors operate in this sort of an environment?
Okay, on that subject about how quickly inflationary pressures dissipate, Catherine, I was listening to David Rosenberg talking to our colleague Tom Keene earlier, and he was saying that the U.S. economy will disinflate quickly. He cited commodity prices, freight rates, all kinds of other metrics that he's looking at. But he acknowledged when he says this to clients, they don't want to believe it or they don't believe it, similar to your view. So why is that view not how you see the world?
Right. Well, one of the reasons is energy prices. There's still a huge supply shortage for oil. We're coming into the winter months. That's going to create more of a demand for natural gas, heating oil, etc. China is coming out of lockdown. So we still continue to see that there's going to be more of an excess demand for these commodities. Food is tied to energy, because it's the transportation costs. Rents are not coming down anytime soon. So we still think that this inflationary environment is going to stick around for a while, and the Fed's going to be there to fight it.
Which is why it's so weird that the consumer confidence number for August was so good. And I'm wondering that, are we in a good news for the economy is bad news for the equity market and vice versa?
Yes, well, the consumers still have jobs, and that's a great thing. You know, this is unlike any other inflationary environment that we've ever been in before, right? Usually when we're coming into an inflationary environment in the past, people didn't have jobs, so there was really almost like a depression type attitude. But consumers are feeling pretty good that they can get work and they can put food on the table if they do need to. Not the prices that they would like to, but they can survive.
Can I ask you about, we're just dealing, Catherine, at the moment with some headlines that were crossing around geopolitics, seem to illustrate some nervousness in the market, but also we just got some better data out of the US in terms of job openings and consumer confidence. And some people are asking, you know, if we sold off as a result, well, it's interesting if we did sell off as a result of that better data, because that goes back to that old adage, you know, that good news is bad news because of what it means to Fed policy. Are we going to be very reactive in that way? Because yes, we're supposed to be data dependent, but how does that mesh with a very hawkish Fed? We know we've fully received this very hawkish Fed message.
Right. We're coming into some very tumultuous months for the markets anyway. So the market is still going to be reacting to every word that the Fed says, every economic data point that comes out, and they're waiting to see if the Fed is actually going to pause, make some sort of a pivot. So the individual investor is looking for that pivot to possibly come into play, but I don't think we're going to be getting it.
I should point out that just looking at the currency market here, euro dollar now pushing below that parity level, stronger dollar, higher yields on the front end, and lower equity market. To Anna's point, Catherine, before we let you go, you have to put money to work in this environment. How much are you in cash, and where's the best opportunity that you'd like right now?
Yeah, we have about 5-6% in cash right now, but we do like the healthcare sectors. We like financials. We like energy. We like healthcare because it's possibly the best risk reward for investors. We're looking at companies with strong cash flows, companies who have the ability to grow their earnings. We like the energy sector for that strong cash flow growth as well, and because we feel that there's a supply shortage that we're going to be faced with. And also financials. You know, financials do well in higher interest rate environments. As the interest rates continue to go up, the net interest margins on these companies looks a lot better. These companies are trading at about a 10 times 2022 earnings estimates, 50% discount to their 5-year valuation levels. So we would focus on the yield, we would focus on growth, and we focus on quality. Companies with above average dividend yield, 2% or better, companies who can grow their earnings, quality companies, quality balance sheets, cash flow rich, great management, and the ability to grow those dividends.
And I know that you say buy those companies and don't buy the market generally. Catherine, we appreciate your thoughts today. Thanks for joining us. Catherine Avery, CEO of Catherine Avery Investments Management, joining us on the programme this hour. Still ahead here on Bloomberg TV, Twitter responds to Elon Musk after he puts out more reasons to get out of his $44 billion takeover bid. He would like to get out of it, of course. Twitter's pushing back. Details next. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Goldman Sachs warns that the downturn in the U.S. housing market has further to go. In a research note, Goldman says it expects home price growth to average 0% next year due to higher mortgage rates and reduced affordability. But the firm says that large price declines are unlikely. Taiwan's China Airlines has ordered 16 Boeing 787 Dreamliners in a deal valued at $2.1 billion. The airline also has options for 8 more of the planes. Deliveries are set to begin in 2025. The Boeing jets will replace China Airlines' aging Airbus A330 fleet. And billionaire Elon Musk has sent a letter to Twitter, adding reasons why he wants to terminate his takeover agreement. Musk says that Twitter may have breached their deal in 5 more ways. The letter was sent after a whistleblower alleged that the company didn't know or care to find out how many of its users were spam or robot accounts. Twitter calls the Musk letter invalid. And that is your latest business flash. Anna?
Ritika, thank you very much. For more on that Musk-Twitter battle, let us speak now to Mandeep Singh of Bloomberg Intelligence, who joins us. Mandeep, help us understand the latest twists and turns in this saga. So my understanding, Musk still says that Twitter's, this time deficient in terms of hacker defenses and wants to end the deal. Twitter's still pushing back. Have we learned anything from this latest news flow?
Not really. I mean, they're trying to really take whatever opportunity they can in terms of, reasons to terminate their deal. But at this point of time, unless there is a fraud element like blatantly not disclosing the information or falsifying the information, I don't think there is a good argument here. Yes, every company could do better in terms of their cybersecurity or corporate governance aspects. But to me, I think when the court sees this is just another reason that he wants to walk away from the deal. And it's not very compelling unless there is an outright fraud here.
Should Twitter stock be down more?
I don't think it changes the odds here, in terms of the deal happening. So he may still be forced to close at the original price. Yes, there could be a concession that Twitter may have to give him for, the cybersecurity issues that they had. But beyond that, I mean, it's an all-cash deal, so there is no stock issuance involved either. And he has already raised the cash, so I see no reason why the deal won't go through unless, like I said, there is a fraud element to it.
Right, and Mandeep, just thinking about the arguments that Elon Musk is using here, I mean, does it damage him? Does it damage his arguments a little bit if he clutches at a number of arguments? It was the bots, and now it seems to be hacker vulnerability. I know this is all going to end in a court, but how will a judge view the fact that he seems to be bringing a number of reasons to the table?
Exactly, and at this point, it feels like there is a noise element to what he is doing, and if he keeps bringing new issues every day, yes, that was part of the due diligence, right? And that should have been looked at before signing the agreement. So, look, I think in the long run, it really hurts Twitter. And my sense is even if he closes the deal, he will look to get out of it. He'll probably sell it as quickly as he could.
Well, this is my point, is that if a judge forces him to buy Twitter when he clearly does not want it, and then as you say, will kind of take any opportunity to say that, what then happens to Twitter if he's forced to buy it?
Yeah, so look, I think the fundamentals are getting impaired here, and we know social media isn't an easy business to operate. Once you lose engagement, it really hurts your core business. So there are a lot of issues here in terms of what the long-term view for Twitter is, but clearly I think Musk is not interested in kind of revamping the business or really helping develop a subscription model. The things that he laid out originally when he, was very aggressive with signing the deal.
All right, Mandeep, great stuff. Really appreciate it. He literally covers like every company. Mandeep Singh of Bloomberg Intelligence. Thank you very much. All right, coming up, we're going to stay with the company theme here. Best Buy shares are actually up after they beat earnings estimates. Maybe it's a theme of it could have been worse. We're going to speak to Brian Nagel, analyst over at Oppenheimer next. This is Bloomberg.
Great questions.
About an hour into the U.S. trading session here, stocks moving a little bit lower. We did get some super solid data out from JOLTS as well as consumer confidence. So Abigail Doolittle is tracking some of those moves for us in the equity market.
Well, we do have a bit of a risk-off tone at this point, Alex, and it is an extension, a 3-day sell-off that started from last Friday with that hawkish tone from the Fed or the realization that there is no pivot. So we have the S&P 500 down about 0.6%. Over the last 3 days, down nearly 5%. So we're really losing some ground relative to what stock longs might want to have happen. We have that VIX back above 26, complacency leaving the market, some uncertainty creeping back in as investors either hedge or are outright making bearish bets. And then we have yields backing higher too, up 5 basis points, readjusting to the idea that the Fed is on track to raise, and most people, the market suggests that in September it will be by 75 basis points. So 3 meetings in a row, a historic 75 basis points. This is really the backdrop for the markets. We also have commodities, another silo of risk assets selling off. If we take a look at the Bloomberg Commodity Index down at the oil at this point down 4.1%. The Bloomberg Commodity Index overall down more than 2%. Natural gas over European natural gas down 26% on the idea that maybe some sort of an energy crisis is going to be managed. You can also see copper is lower, and there's that Bloomberg Commodity Index down 2%. Now, Alex was just mentioning the jobs data and the consumer confidence data. Consumer confidence obviously beating. Here's the job openings data, the JOLTS data for the month of July, ticking higher off of the highs, but nonetheless a little bit higher than expected. So we have lots of openings out there, job openings. It's hard to know what way investors are taking this right now. You can make a bullish or a bearish case. That's true too for the technicals. Right now we're stuck in the middle, lots of uncertainty, investors waiting for more direction one way or the other. This is the chart that we've really been tracking all year. This is the bear market, that downtrend, that strong downtrend. Here is the bear market rally right on cue, coming off of resistance at that 200-day moving average. Right now, right below that 50-day moving average. If we close below that 50-day moving average today, Anna, and for a number of days in a row, it strongly suggests that this bear market could take over and that we could actually see a new low on the S&P 500. We're far from that point right now, but it's important to watch where the buyers step up or not so much.
Abigail, thanks very much. Bloomberg's Abigail Doolittle on the market. Let's dive deeper into one sector, and we'll start with the Best Buy story. Shares are up after beating estimates. The company slashed profit and sales outlook back in July. Joining us now is Brian Nagel, Oppenheimer's managing director. He has a market perform rating on this stock and covers many others. Brian, really nice to have you with us. Let's start with Best Buy, but then I'm sure we'll broaden the conversation out. So this is the company that warned a month ago, and now it reports numbers that comfortably beat those lowered expectations, and expectations had been lowered a lot. So net, thinking about July and today, what did we learn about the business?
Well, thank you. First off, thanks for having me on your show. Look, I think Best Buy, I just got off the company's conference call, a short while ago. And but I think about what's really the bottom line here is, here's a company that's in, so to say, the crosshairs of a number of cross currents right now. Okay. Something we've been talking about for a while, and that is, as the pandemic is subsiding, consumers have gotten back to pre-pandemic activities, traveling, entertaining, and that's likely weighing upon sales of consumer electronics. So Best Buy's being hurt by that. There's a lot of talk out there about a weaker consumer. I still think, generally speaking, the consumer's in good shape, but we are seeing some pressures amongst particularly mid or lower income consumers with inflation. Best Buy's getting hit by that. But look, I think overall, I think this is one of the reasons the stock is bouncing today is that what Best Buy's managing a lot of this really well. Yes, results are weak. They're weaker than we initially expected to start the year, but the company's actually managing through these cross currents quite well.
Well, and then to that point, you just take a look at where sales fell, right? They fell most in computer and home theater. That to me definitely says maybe a normalization after 2 years of a COVID pandemic, right? So to that point, Brian, how are they looking into the holidays? Do they have the right stuff? Are they going to have to discount it to get it out?
Well, look, so I'll take your question maybe two pieces. One, I totally agree. I mean, there were categories like those that you mentioned, home theater, home computing, that benefited significantly through the pandemic. Okay, so now we're seeing the other side of that. Now, as we think about the holidays, I think that's a great question, and I don't really know the answer. there's definitely risks. I mean, Best Buy talked about on their conference call, with either weaker spending or let's just say the combination of weaker spending and now better flow of products through the supply chain. There are higher, more normalized, if you will, price promotions at Best Buy and within the sector. Typically the holiday is promotional for consumer electronics. So I think what we're seeing here is kind of the leading indicators that would suggest that as we think about holiday 22, that it's going to be more promotional. It's definitely be more promotional than it has been the last couple of years. That's probably in the Best Buy numbers, but that will represent another headwind for the business.
You mentioned, Brian, that this is a business that you say it's got challenges, but it's managing things pretty well. Broadening the conversation out to the host of other businesses that you cover, which of the other businesses would you say that also applies to? Because they're all going to be facing challenges and headwinds, but how management manages to control the things it can control will be important.
Yeah, so look, I tell my clients a lot right now. So as you mentioned, I cover a number of consumer stocks, right? And very fluid backdrop. In fact, the backdrop is probably more fluid than I can remember in my time covering this space. But I'm really trying to pick my battles, so to say. So as I look across the space right now, look, I think home improvement, Home Depot and Lowe's, we heard from those companies the last couple of weeks. Trends are decent there. I mean, better than decent. They're solid. And probably most important is they've actually gotten better lately. So I think that's one area to be focused on. We talked a lot about the auto parts retailers. In my mind, auto parts retailers, so companies like AutoZone and O'Reilly, are benefiting from historically strong consumer demand. And then I also like the athleisure space, the Nike and Lululemon. I know those are more controversial at this point, but I still think underlying demand for that product category is quite good.
So, and Lululemon reports on Thursday, I should point out too. Hey, Brian, how exposed is your sector to the housing market? And you had Goldman having a call that says the downturn in the housing market has further to run as those borrowing costs rise, as the Fed hikes rates, etc. What's the direct line between something like that and then the stocks that you cover? Like if rates rise or my home is worth less than it was, am I going to go buy a $90 pair of tights from Lululemon?
Well, look, okay, so there's definitely a relationship between a lot of the retailers, the brands that I cover, and housing. Okay, but the relationship is not nearly as clear-cut as the market wants to believe. Okay, so I'll talk about Home Depot and Lowe's for a second. So, look, I mean, we're starting to see now, and I think this is what the Goldman article pointed out, or the Goldman comment pointed out, we're starting to see a moderation in home price appreciation. Okay, so that's something to keep an eye on. But if you look at the way homes have appreciated now over the last several years, I mean, there's a lot of house wealth out there. Okay, and that's a big driver for sales at Home Depot and Lowe's. I don't think that positive is going away anytime soon. Another way to think about this with the home improvement names is rates have risen. The affordability of a new home becomes more challenging, right? So that's likely to keep people in their existing homes longer. When someone stays in their existing home longer, they're more likely to put money into that house, and that's also a positive for Home Depot and Lowe's. So look, there's definitely a relationship between housing and a number of these retail names, but again, it's not as strong as, or is coincident. That's probably a good word. Coincident as the market wants to believe.
Brian, is the strong dollar making life better for some of the businesses that you're mentioning here? Because when we talk about big U.S. international businesses, sometimes they're damaged by the translation effects of that strong dollar when you bring back profits from overseas that don't look as good. But these are many domestic businesses that you're talking about here. Are they benefiting quite a lot from the strong dollar?
Yeah, so it's generally speaking, this is there are benefits for strong dollar. So as you point out, most of these retailers do not operate in any significant way stores overseas. They have markets here and there, but for the most part, they're domestic businesses. Where they could benefit is on the sourcing side. So a stronger dollar would allow domestic retailers to source products more cost effectively. So that could be a positive. Now, conversely, though, and again, this is more of a when I say this, it's not every retailer gets impacted by this, but when you have a strong dollar, you get less foreign tourism spending within the United States. Mm-hmm. Now, for a company like Home Depot, that's probably a non-event. But that could impact somewhat names like Nike and Lululemon. To the extent that some of their business actually reflects consumers coming from overseas to the United States and spending here. And that is in a stronger dollar environment that would be impacted.
Yeah. Hey, Brian, before we let you go, you used to cover GameStop. You used to cover Bed Bath & Beyond. So I'm not going to ask you specifics, but I did want to get your take on the meme stock trend versus fundamentals. How do you look at something like that that's still going on in the market, despite all these headwinds that we keep talking about?
No, on that, I really have no idea. You're right. I covered those names many years ago when those businesses, like the ones that we're talking about today, actually trade on their fundamentals. I have no idea about those stocks right now. I'm frankly been too busy covering all the names I do cover, so I would only be guessing.
Well, you and everybody else, I think, is the point to that. Hey, Brian, thanks a lot. Brian Nagel of Oppenheimer. Thank you so much for joining us. I just want to point out, guys, that you have S&P really ran the lows of the session, now off by a full 1 percentage point. The Nasdaq 100 also off by 1.3%. It has really picked up steam after that solid data, the consumer conference data, as well as the JOLTS data. And I think we can then make a line that you have good data means hawk Fred means bad for stocks. You also see the 2-year yield jumping by about 7 basis points. All right, coming up, we're going to track the consumers even more. They're still spending. Look at the confidence numbers that we just got earlier in the hour. But what it means for, say, jewelry makers. Pandora, for example. We're going to speak to the CEO coming up next to see his trends in the industry. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. It would be the largest transfer of U.S. weapons to Taiwan in almost 2 years. Bloomberg's learned the Biden administration is preparing to sell $1.1 billion in missiles and radar support. The sale doesn't offer Taiwan any new military capacity. Still, it's likely to lead to more protests from China. Ukraine has launched an offensive along the southern front of its war with Russia. The Ukrainian military says its artillery hit Russian positions around the Kherson region. Kherson is a river port that was one of the first cities to fall to Russian troops. And Bank of America is testing a program that will offer no down payment mortgages for first-time homebuyers in Black and Hispanic neighborhoods. The loans also won't require closing costs or minimum credit scores. All of those have been considered obstacles to narrowing the gap between white and minority home ownership. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. Let's get back to that data from the top of the hour. Consumer confidence numbers super strong. JOLTS numbers really strong. The U.S. consumer is still bullish on the economy, and they're still bullish on the jobs market. So how are they spending them when it comes to different categories? We just talked about Best Buy, so let's talk about jewelry. Let's go to Pandora. The U.S. is Pandora's largest market, and joining us now is CEO Alexander Lasik. Alexander, thank you so much for joining us. We appreciate it. Earlier this month, you reported that U.S. sales are dropping, right? There was a really strong 2021 spend, etc. What are you noticing now as gasoline prices have come down, but the sentiment is still pretty strong within the consumer confidence world?
So we have to back out a little bit. If you look at the jewelry category over the last 10 years in the U.S. grew a couple of points ahead of GDP. Then last year when the stimulus checks came from the U.S. government, then the category jumped and grew by 50%. So coming into this year, it was quite clear to everybody that participated in the category that it would kind of shrink and go back to a more normalized situation. So we can kind of see that as we started getting into March and onwards, which was the time when the first checks dropped, that the traffic into the category as a whole started coming down a little bit. So we always assumed that this year would be a contraction on the basis of that kind of unnatural growth that we experienced last year. So I don't think that there's any surprise in that respect.
Okay, so we are talking about a bit of normalisation, Alexander. A good afternoon to you from London. What is the extent of that negative trend, I suppose, versus last year that you expect to see now? How bad do you think things will get for you in the US in 2022 in the context you just described? And what can you do to try and mitigate it?
Well, I mean, it's a bit of a guessing game. Coming into this year, we did some, assumptions on that, and we said, well, maybe the category will contract anywhere between 15 and 20%. But of course, that was a bit of a guess. And then we said that maybe we can do a little bit better than that, and that's somehow what's currently playing out. Now, on the assumption that it's not going to change in the back half of the year, then that's probably where we'll land the year, somewhere in the kind of, let's call it minus 10% or so, yeah.
When you take a look at, say, your EBIT margin target range, it implies a pretty strong back half to get to where you need to be, which is 25.5% on the high end for 2022. Talk to me about your confidence that you can get there in terms of your costs. At the same time, costs are going to be rising as well. How do you avoid that? How do you avoid the inventory build that a lot of other retailers are dealing with, or brand dilution, for example?
Okay, so if you look at the year, Q4 is a significant portion of our sales, given kind of it's a gifting brand and when we get into the Christmas period. So we have a natural kind of progression with the EBIT being a little bit lower in the first 3 quarters and then to make a jump towards the 4th quarter. So if kind of the forecast that we are working on holds true, then the guidance will work out the way we have suggested. As you say, the EBIT margin is going to be around the 25 to 25.5%. Then if you look at the input costs, we have our major input cost to Pandora is silver. What's happening when interest rates go up, silver price typically goes down. So therefore you could say, well, we should get a benefit of that. However, we have a 12-month rolling hedge, so we avoid these kind of jumps up and down on the spot price. So coming into the back half of next year, we should actually get a tailwind. That's kind of one major factor for us. Then from a freight standpoint, I mean, our products are small, don't weigh a lot. We air freight that, so actually is not a major impact. So from an input standpoint, we're relatively in a good position.
Okay, can I ask you about China, Alexander? I know that's not a huge part of your business right now, but you've wanted it to be bigger. You had to delay a brand relaunch because of challenges in China. What are you seeing in China? When do you expect that relaunch to take place?
Yeah, so China used to be roughly 10% of our business. Now it's around 4 to 5% of the business. And of course, it's very difficult trading conditions with this policy that the Chinese government is enforcing with the zero tolerance. What that does for us when we're kind of in the situation that we're looking to do a relaunch of the brand is that we need to kind of understand that the conditions are somewhat stable. So it's difficult to put a lot of money in and then all of a sudden a city like Shanghai with 25 million people shuts from one day to the other. So what we need to do is to, at least understand that there's a bit more stability in the market before we then put these plans to work.
Are you seeing any signs of normalization?
So far, not really, to be honest.
When you look at that then in terms of the COVID policy, and then if we could pivot back here to the U.S. for a moment, are you noticing the type of consumer that's coming to you? We talked a lot about the middle, upper, and lower income consumer and then how they're spending, and that middle income consumer kind of retrenching. What are you noticing?
Well, if we look at the average customer that comes to Pandora stores, specifically in the US, we have actually a slightly higher than average category customer coming to the Pandora stores. And of course, last year, all these cohorts increased when the stimulus checks came. And what we've seen, let's say, sequentially coming into this year, that these cohorts have slowly started kind of to seep out a little bit. So we can see that the traffic across all cohorts essentially have gone from being in a quite positive space last year into somewhat of a negative space this year. So that's what we're seeing.
Sticking with the US, Alexander, I know that you launched your lab-grown diamonds offering in the United States. I know it's very early days. I think that was only either started this week or maybe just the end of last week that you launched that. I wonder what kind of feedback you're getting, any early signs of how this is going down in such an important market for you.
Well, I mean, we're super excited to launch Diamonds by Pandora. It's been in market for 5 days, so that's probably a little bit early to report any trends. We had a big event last week with press and influencers, a high level of excitement. I have to say, I had the opportunity to go over to New York myself. We visited a couple of stores. The store staff is very, very excited, and a few of the customers that we spoke to as they entered the stores are also very excited. So I think lab-created diamonds as a concept is really starting to kind of pick up speed. So hopefully we're catching a good trend here.
Okay, thank you so much, Alexander Lacik. Thanks very much for joining us, the Pandora CEO, talking to us about how the business is doing in the US, in China, and elsewhere. We'll take a short break. When we come back, we'll get more on the markets. US stocks under pressure. The stocks, the S&P down by 1.4%, NASDAQ down by 1.5%. More next. This is Bloomberg.
U.S. markets under some serious pressure here. The S&P and the NDX are both below their 50-day moving averages, and this chart actually shows you why. So we wanted to take it a moment and point it out. So the blue line is the S&P rolling over, just as I said. The white line is market estimates for the Fed end rate of 2022, and you can see that rising near the level that we saw back in June. The idea is we're near that peak hawkishness feeling, and that's putting pressure on stocks. And the why was very clear, Anna. In particular, the JOLTS data that we got out at the top of the hour came in really strong. What it shows is the gap between supply and demand for jobs is really wide. So that puts the soft landing more off the table. The Fed's going to have to do a lot of work to close that gap. And can they really prevent a big slide in unemployment, a big rise, I should say, in unemployment and layoffs in order to do that? The market's weighing in. The market's saying, nope, we don't think so.
Yeah, and if you're looking for signs that the Fed is succeeding in weighing down on aggregate demand, then maybe you look for the jobs market to respond and for that JOLTS number to come down a bit, and that just hasn't happened. And so, yes, your point then, Alex, that good news turns into bad news in the market psychology, and there we are. Stocks sell off. Add to that a little bit of Taiwanese jitters around the top of the last hour, and that also seemed to take the edge off, even if the nature of that drone activity is not entirely clear. So those things have been weighing on stocks in the US and weighing on stocks here in Europe as well. We can see the Stoxx 600 is firmly in the red now. We've given up on our earlier enthusiasm. We were firmly in the green earlier on today, down by 0.7% right now. The euro also was gaining earlier in the day as we had some. It was a turn of the hawks. Yesterday we heard from Lane, the turn of the doves. Today we heard from Klaus Knott at the ECB, and a little bit more hawkish message that led to euro gains. Well, now that hasn't lasted, and as we've seen a little bit of risk appetite leave the market, we've seen the euro sell off a little bit. It's down 0.1% against the US dollar, and we've got the UK 10-year yield for you in there as well. We've seen that at the highest since 2014. Along the curve, though, yields increasing as we see a reassessment of Bank of England rate hiking expectations. That is something that we will pick up in our next conversation with Peter Chatwell, who joins us, Mizuho Head of Global Macro Strategies. That conversation coming up shortly. This is Bloomberg. It's Tuesday, the 30th of August. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Welcome back to Bloomberg Markets, or welcome to Bloomberg Markets, the European Close. I'm Anna Edwards in for Guy Johnson here in London with Alex Steele over in New York. Let's have a look at the markets. Half an hour to go until the end of Tuesday's trading session, and this is what the market picture looks like. The Stoxx Europe 600 is down by 0.6%. We actually started the day quite positively. Risk appetite was fairly solid, or at least we were seeing a stabilization in risk appetite after the selling of the last couple of days, the Fed-induced and the hawk-induced selling that we've seen on both sides of the Atlantic. Today started out a little bit different, looked more positive, but now succumbing to the downside, driven by, as we discussed before the break, the more positive data out of the US, leading to a knee-jerk pricing in perhaps of more hawkishness from the Fed. So that was one part of it, and also a few geopolitical jitters adding into the mix as well. Interesting, Brent crude has dropped quite considerably today, down by 3.9%. It dropped actually below $100 a barrel earlier on, or at least was threatening to. And part of the reason here is that it had run up a little way on fears that violence in Iraq was going to lead to disruption to supply. There are concerns about disruption in supply in Libya, but it seems Iraq looking more calm in the oil sense than had been feared, and as a result the price drops a little bit. And Alex, I mentioned this a little earlier on, the UK 10-year yield, we've seen some movement here, and in fact across the curve as the market continues to rethink and reprice where we go, and hawkish messages seem to be landing in terms of the Bank of England narrative, and that has been pushing yields a little higher for the UK story, at least today, Alex.
Yeah, and I feel like also there's a little bit of catch-up